Coming up today, stocks close at all-time highs on the back of inflation data meeting expectations. Where to next for the Fed? Why we could be going into the mother of all bubbles? Retail sales disappoint, commodities surge, and a look at the latest moves from some hedge fund managers. Well, there we are guys, new all-time highs on the S&P 500. Just as we've been talking about, it's been nothing but up and to the right. Since Jay Powell and Janet Yellen came out at the start of this month, backstopped the market and off we've went. And so I had been thinking we may pause and have a look above here, maybe a bit of a head fake. However, looking at today's price action, it's looking pretty strong there. The market is well supported and pretty much firing on all cylinders here. So I'm not sure if we even pause here, rather just keep running away because we haven't even had so much as a 0.5% pullback ever since Jay Powell and Janet Yellen came out and loosened financial conditions, inevitably putting us on a path to new all-time highs. Same deal on the Nasdaq Qs, breaking out to new all-time highs, and crowd favorites like NVDA, less than 30 points away from new all-time highs as well. So inflation was expected to grow 3.4% year over year, in which it came in line. And so it's interesting, isn't it? The market's reaction, and that's why you got to pay attention to the tape, as the market doesn't lie, and that's why it's important to follow the technicals and not just the data, but more importantly the market's reaction to the data. And so here we are in this environment where 3.4% inflation is considered good, and the market really loves that. However, I think it's a case of liquidity and sentiment, and just the Fed's policies in general are so supportive of the market nowadays that it's got nothing else to do but run higher on all this excess liquidity. And as long as inflation doesn't blow out above 4%, which is still possible in the coming months later this year, this market should keep partying like it's 1999. And because of inflation coming in line with expectations, that pretty much rules out the possibility of a Fed rate hike at this moment, even though we already know that. Jay Powell pretty much said those exact words. He's not going to hike. Nonetheless, we got Treasury yields pulling back today. Can see that in the 2-year, taking out this support, finishing at 472, along with a bit of a pullback in the 10-year, now down to 434. And along with that, the spread of inflation expectations, still pulling back as it has been for the last couple of weeks. And so the Fed put is well and alive. They've backstopped regional banks, commercial real estate, and the entire market itself, pretty much indicating as soon as it gets a chance to cut rates, it's going to go ahead and do that. And that could come in July, if not September. Even though some in the Fed, such as Kashkari, sees rates staying on hold for a little longer. He's a little bit more hawkish than the chair, Jay Powell. But at the very least, for now, it buys them some time to wait and see. As soon as we get a good print on inflation, in tandem with an uptick in unemployment, which could actually help inflation pull back, we see the unemployment rate go to 4% or above, he's going to come out and cut for sure. And so as we can see in this chart, US financial conditions are very loose. Back to those 2021 levels, when everything is flowing. Got the momentum in the market, strong possibility of rate cuts. It's no wonder we're ripping really strong here. However, just taking a bit of a step back from the here and now, just looking at the holistic picture. Valuations on a number of measures are approaching record levels. Just looking at the 10-year PE ratio, now almost back to 2 standard deviations above the historical trend. Only really been above that in late 21 and the tech bubble that burst in 2000. Also looking at the S&P 500 valuation relative to interest rates. That too is in overbought levels. And looking at the inflation-adjusted S&P 500 with an exponential trend line, that's just about as overbought as it's ever been since late 21, 62% above the long-term trend line. And then finally, looking at Warren Buffett's favorite measure of market valuation, that's the ratio of market cap to GDP. I would say today we're pretty much at 200% market cap to GDP. That's 2 standard deviations above the historical trend line. And looking back through history, every time we've got up there, that has been a bad time to buy stocks in the long term. We're typically near a historical peak. However, this time's different because of AI, right? So before we've broken out to new all-time highs, one could have said we may have been in this return to normal phase. This may have been 2021 when things got ridiculous. Pictures of rocks and monkeys selling for millions of dollars, meme stocks, meme coins, all that good stuff. And we fell over in 2022, had a really good bounce back in 23 and ripped up further into 24. However, the fact that we've taken out all-time highs here and with so much gusto, and now we've got meme stocks, crypto and everything, call option volumes, that's all coming back to these 21 levels. Maybe we haven't even reached this stage yet. Maybe we're still on this greed delusion stage, and we still have the potential to go into the mother of all bubbles and blow off tops. Because looking back in market history, just on crowd psychology, ever since the tulip bubbles back in Amsterdam in the 1600s, humans themselves have been able to carry markets to dizzying heights. However, what's different this time is we're at the biggest financial experiment in the history of humans, with the Federal Reserve artificially creating $9 trillion of money and pumping that into markets. In addition to signaling to the market anytime something goes wrong, they'll be there to backstop it, stimulate it, and do whatever is necessary to get things moving back in the right direction again. So in addition to normal greed and fear, human psychology, that could give us the ingredients to give us the mother of all bubbles. And just looking at a long-term 6-month chart at the S&P 500, maybe that means we're on a crazy path to 10,000 on the S&P 500 before having the inevitable blow off top. And then maybe there'll be a huge public spotlight on the Fed and what they've done to markets, because all this asset price inflation will spill over into the real economy, and it could be years and years before we see inflation below 2% again. And like I said, the Fed and the markets may be really happy with 3% inflation. Fed's still going to stimulate, they're still going to cut rates. Doesn't matter about that structural embedded inflation over the last couple of years, and we could be really on a path to the moon here. And don't get me wrong, just because I disagree fundamentally with what the Fed's doing and has done to the real economy and real people, got stock markets at all-time highs while most people out there are suffering, there's still good money to be made in the market. As typically in bull markets, the best gains come at the start of the bull market and at the end of the bull market, percentage-wise, when things get really crazy. And so one strategy that works really good in this environment is buy the dip. Anytime the market gets a little dip, or any strong stock, uptrending stocks, it's a really good strategy to buy the dip. And I've actually got a complete trading system that systematically buys the dip and has been doing really well lately, as we've got a lot of uptrending assets out there. Large cap stocks, small cap stocks, commodities, cryptos. My stock swing bot works on all assets from around the world. You can easily automate it with no programming, or have real-time alerts sent to your mobile or email. So if you're interested in learning more about that, click the link below this video. And there's a coupon code there as well to give you a discount on this complete trading system of mine. And that comes with a 7-day money-back guarantee in case you change your mind as well. And if we are going into that mother of all liquidity Fed-induced bubbles, then what could really go even more crazy than the S&P 500 is the proxy for liquidity, Bitcoin, which was created at the start of this secular bull market back in 2009. Now, it was a little strange because yesterday we had meme stocks ripping up, but Bitcoin pulled back. Today we've had the opposite. We've had GameStop and AMC have a bit of a sharp pullback, whilst Bitcoin has popped up a little bit here. We can see that on the chart. Bitcoin rising over 7.5% on pretty good volume, and I'd say this is bound to hit new all-time highs as well. Now that they've got the stock market rocking, you'll find there's quite a lot of correlation between especially the NASDAQ and Bitcoin, or basically just risk-on mode. And maybe we're just having a pullback here in GameStop. Maybe this may not be over, even though we're down 18% in the regular session, 9% more after hours. Same deal with AMC, down quite sharply today. Be interesting to see if they hold these lows from when we first took off on Monday. Based on pretty much nothing else but a non-corporate person on social media posting some memes with no text at all, calls these companies to add billions and billions of dollars in market cap, just to give you a bit of an idea of the type of market we're currently in. But like I said, most consumers outside of Wall Street, they're pulling back on their discretionary spending, like we saw in the sentiment survey last week, taking a nosedive. People's expectations of inflation going up, the highest it's been in years, meaning they're feeling like already the prices they pay for things are going up. While we've seen Starbucks and other retailers, sales pull back as consumers are just buying what they only really need to buy. And we saw that again today with April retail sales disappointing. Economists were expecting a 0.4% increase in sales. It actually came in unchanged, flat. Pretty big miss there. And we got a bit of a revision in March as well, down to 0.6 from 0.7. And the market did reflect that somewhat today. The retail sector ETF was the worst performing, down 1.26%. And it's interesting because the consumer still makes up 70% of the economy. Still very important. But like I said, got to pay attention to the price action. S&P 500 doesn't seem to care about the weak consumer here. And like I said, we're in an environment now where 3.4% inflation is cheered on as being a good thing. Why? Because liquidity, sentiment, the Fed and Treasury are all at extreme record levels for supporting this market. Financial conditions are really loose. Markets pretty much got nowhere else but to go up. And that's further evidenced by a huge VIX crush today, down 7% at 12.4, and I'd say we're likely to come down to low 12, maybe even go down into the 11s with the S&P 500 breaking out to all-time highs. I'm still going to be legging into some hedges. Just going to roll out my dates to August, September, because I still think we inevitably get that VIX pop going into the election. Even if the market doesn't fully roll over, I think volatility at some stage will have to increase, going into early November, and it's also a good hedge against the unknowns. So I'm going to stick it out in this trade and hang in there until we get that pop. Moving on to commodities, we've got oil holding ground here today on a decline in US supplies. Been a bit of a change of late, but we've got some other big moves happening across the commodity complex. We've got silver posting the highest close in 11 years, gold ticking back up, and copper surging to fresh record highs. And there's a look at crude. Market bought the dip there today, just holding in the support zone below $79 a barrel. Gold looks to be ticking up a bit higher there. Nutty gas is going for a run. There's copper reaching new all-time highs. Uranium's ticking back up. Wheat's still holding its good uptrend, along with corn. Now we've also got orange juice ripping higher on volume. Some big moves coming in commodities here. And it's just hard to see if all these commodities keep ripping higher and higher. How does inflation get back down to 2%? In the next couple of months, like some people are calling for. And so we're starting to see what moves some hedge funds have been making in Q1 this year, as they've had to report their Form 13Fs. And Michael Burry of The Big Short got rid of his Alphabet and Amazon and buying shares of gold ETF. And there's a look at his portfolio and recent changes in Q1. In addition to getting into gold, interesting to see his top two positions are Chinese stocks, JD.com and Alibaba, which he heavily added to. And what also caught my eye today, one of the best hedge fund managers of all time, billionaire David Tepper, also aggressively adding to positions in Chinese stocks while reducing his exposure to American stocks. His biggest position now, Alibaba, reducing Amazon, Microsoft, Meta, NVDA, and Alphabet, along with AMD. Similar moves to Stanley Druckenmiller, and also adding Pinduoduo, Baidu, FXI, China Large Cap ETF, also JD.com, and the China Internet ETF, KWEB. So he's pretty much reducing American exposure and increasing Chinese exposure. Those who regularly watch my channel know I was calling out for a Chinese bottom at the start of this year. It's been really great value, and now it's clearly the leading international stock market this year. Looks to be on a strong rip here. There's KWEB, China Internet ETF, that David Tepper just bought into. Barber sold off a little bit after earnings on a slight miss. Bounced back a little bit there today. And a small cap stock I'm invested in that's exposed to the Chinese market, as it allows investors all around the world to directly invest in Chinese shares, Tiger Brokers. Up more than 20% since I mentioned it to you guys a few weeks ago, and higher highs and higher lows again here today. And this stock too has been an easy buy the dip these last couple of weeks. Let's look at Fed Fund futures. Pretty much pricing in 3/4 chance they're going to cut in September. We get some more inflation prints in line. Doesn't matter if they're still above 3%. We may even get a cut in July and potentially another cut in December. And Corporate Insider's not doing a whole lot of buying here, neither selling. Pretty much a normal spread between selling and buying there. Also got small caps joining in on the action, close to breaking out to yearly highs, and looks to be in a healthy bull market with plenty of breadth now. Almost 80% of stocks above their long-term 200-day average. And we're starting to come back up in new highs versus new lows. Same with high-yield bonds. Looking to potentially come back up to yearly highs. It's a good sign for risk. Also helping the stock markets, the dollar dropping below the support zone. And it's not just the States. We've got global equity breadth out there, especially European stocks. There's German's DAX breaking out and the Nikkei starting to bounce back as well. And previous leading sector semis making a strong recovery here today, up 3%. Now within a smidge of testing all-time highs. Same deal with home builders and even regional banks finding new multi-month highs. At the same time, we've got gold miners breaking out as well. Energy stocks overall still a little subdued, and previous leader industrials coming close to all-time highs. At the same time, we've still got the defensive sector of utilities, walking the line, ripping higher, loving these lower yields. And the winning factor today, momentum stocks, hot stocks back in the mix. Cannabis still tracking sideways, a little quiet there. And Apple holding up, defended his big earnings gap. Buyback seems to have shaken off worries of Warren Buffett selling. Here we are, trading at 189. Along with Meta reclaiming its 50-day VWAP. Still a little weakness in Tesla though. And some of these retailers coming off a bit today on that soft retail sales report. There's Starbucks, TJX, Nike, Best Buy falling 1.3%, and Macy's down 2.7%. Some of those stocks I thought may pull back into those retail sales went ahead and did that today as well. Whilst the large financials are still in good shape here, ticking up to new highs. Alright guys, so there we have it. I think I can remove this resistance zone here. I'm not even sure if we're going to come back and retest that. Just looking at this big green candle and just how the market reacted today to an inflation coming in line. Even though it's 3.4%. Even though retail sales disappointed, the consumer's pulling back. Like I said, you've got to pay attention to the tape. Technicals lead, fundamentals follow. And ever since Jay Powell and Janet Yellen came out, we have just rocketed up here. And I'd say that's given the market a bit of fuel to keep pushing higher over the coming weeks and months. And this 6% pullback we got last month may be the biggest pullback and drawdown we get all year, especially in an election year. We could be easily on our way to 5,500, who knows, even 6,000. And like I said, if we're in a real mother of all bubbles, that could still go on for a year or two, and we could be on a path to S&P 500 10,000. And as ridiculous as that is, and what will inevitably call in the Fed's policies into the spotlight, as it will massively increase the wealth inequality gap, as we're on a path to the top 1% owning over 90% of all wealth. For the here and now, it doesn't really matter. Us as traders and investors can still make money on that, riding these trends, buying the dips, but just keep in mind we could be on that path to the mother of all bubbles and bangs. And even though we all know it's overvalued, and in 10 years it could be even lower than where we are now, that's hard to prepare for and respond to. The best way is through diversification internationally and across asset classes into commodities, whilst adding some tactical hedges along the way. Easier said than done, but we're all going to try, right? Thanks very much for tuning in to the Click Capital Daily Market Review. My name's Jared, and I hope to see you again tomorrow night. Cheers.